In this video, we will learn about how to find out which companies are good for long-term investments with the help of financial ratios. Well, for that, we need to analyze a few factors. First is earning per share. EPS is the ratio of total profit or earnings of the company to the total number of shares of the company. EPS is calculated as total earnings divided by the total number of shares. An investor can know how much money he can earn from a single share. The more the EPS value is, the better the company is. Next is price earning ratio. PE ratio is the ratio of share price to the earnings, where earning means nothing but the EPS. PE is calculated as share price divided by EPS. PE ratio is useful to determine the valuation of a company with respect to its share price and also to compare with other companies in the same sector. Investors and analysts believe that the less the PE ratio is, the more attractive the stock is. Next is debt to equity ratio. It is the ratio of the total debt of the company to the shareholders' equity. It is calculated as debt divided by total shareholders' equity. Debt to equity ratio calculates the total debt or borrowing of a company in comparison to its net asset or total shareholders' fund. The debt to equity ratio is high or low. It totally depends on the sector or industry. Ideally, the debt to equity ratio should be 0. Next is quick ratio. Quick ratio or acid test is the ratio of the difference between current assets and inventories to the current liabilities. Quick ratio is calculated as current assets minus inventories divided by current liabilities. Quick ratio is useful to know how fast a company converts its inventories into assets. Quick ratio or acid test of the company should be at least 1 times or 1:1. Next is return on equity. Return on equity is the profitability ratio. It is the ratio of net profit to the total shareholders' fund. Return on equity is calculated as net profit divided by total shareholders' fund. Return on equity is used to understand the efficiency of management and to have an overview of how much returns a company has gained on investors' or shareholders' funds. Return on equity of any company should be at least 25%. The higher the ROE is, the better the company is. Here's an example for you. Let's have a look at calculations for TCS. We will try to find out the values for all the previously discussed terms. You can pause the video for a while and have a glance at all the respective values on the screen. As you can see, the share price of TCS is 3,827 rupees. Let's find the EPS value. As we have discussed, the formula for EPS is total earnings divided by total shares. The total earning of TCS is 32,562 crores divided by total number of shares, which is 375.24 crores, which results in 86 rupees. The more the EPS value is, the better the company is. Next is PE ratio, which is calculated as share price divided by EPS. As the share price of TCS is 3,827 divided by EPS, which is 86, results in 44.25. Let's move on to debt to equity ratio, which is calculated as total debt divided by total shareholders' equity. As you can see, the total debt for TCS is 0. Thus, the DE ratio also results in 0. Ideally, the DE ratio should be 0. Now we will find out quick ratio, which is calculated as difference between current assets and inventories divided by current liabilities. Current assets of TCS are worth 99,280 crores minus the inventories are worth 0 divided by current liabilities 34,155 crores, which results in 2.9 times. The quick ratio should be at least 1 times or 1:1. Lastly, return on equity, which is calculated as net profit divided by total shareholders fund. As the net profit is 32,562 crores divided by total shareholders fund, which is 86,433 crores, which results in 37.63%. Higher the return on equity is, the better the company is.